In this section, we're going to review asset, liability, and equity accounts. A lot of these you have seen before, but I'm going to introduce a few new terms. The typical asset accounts you'll see for a business are cash, accounts receivable, you'll see note receivable, again remember the difference between the two, prepaid accounts, these are prepaid expenses. We'll talk about those in a little bit. Supplies, these are items that companies buy in bulk, but as they're used up, they become supplies expenses. So we treat them as supplies when we purchase them in bulk, and as we use them up, we will move them to supplies expense. And then you'll see assets that we use over a long period of time, such as equipment, buildings, land, and then you'll typically also get furniture there too. Now let's talk about prepaid expenses or prepaid accounts in detail. When we talk about prepaid accounts, we're typically talking about prepaid expenses. That is where a company will make an advance payment for future expenses. Let's take a look at an example. Let's say that a company wants to buy insurance for their vehicles. Insurance costs are either $1,000 per year or $100 per month if you pay monthly. Since there are discounts if you pay in advance, the company decides to pay that $1,000 per year. Now, let's take a look at this $1,000 per year. What does this $1,000 per year entitle the company to do? This $1,000 per year entitles the company to use up insurance services for a whole year. You pay for it upfront, and you have the right to use that insurance the entire year, which is treated as an asset in the company. So the prepaid insurance is shown as an asset on your balance sheet. These assets become expenses as months go by and insurance is used up every month. Prepaid insurance, prepaid rent are typical prepaid expenses that companies pay upfront. Next, let's take a look at liability accounts. There are two that you already know of, accounts payable and note payable. And then there are two new ones, unearned revenue and accrued liabilities. Let's take a look at those two next. First, let's take a look at unearned revenue. If you remember from Chapter 1, revenue is what a company earns when they sell goods or services. And revenue is earned when the goods or services are provided to the customer. Well, then let's take a look at how we get unearned revenue. Unearned revenue occurs when a customer pays in advance. When a customer pays the company in advance, unearned revenue is created. This is a liability for the company. It is a debt that is owed to the customers. The company is now responsible for providing the service that the customer has paid in advance. Let's go back to that same insurance company example. We said that the terms were $1,000 paid per year or $100 per month. If the customer pays $1,000 in advance, it becomes a liability for the company. For the insurance company, it is a liability. Why is it a liability? Because now the insurance company owes 1 year of insurance services for the customer. As months go by, this unearned revenue becomes earned revenue as insurance services are provided for the customer. Next, let's take a look at accrued liabilities. Accrued liabilities are amounts that are owed but have not yet been paid. Typically, we're talking about for expenses. Let's take a look at an example. Now, let's look at a timeline here, and we got the month of May and June. Let's take a look at electricity. We know that electricity is used up during the month. So for the month of May, the electricity that's used up is paid in June. We receive the bill in June and we pay it in June. But remember, the matching principle says that even though we paid this bill in June, this bill was for May's electricity expenses. So we have to treat it and record it and report it as a May electricity expense. But when we report our financial statements for the month of May, we have not received our electric bill. So we're going to show this electricity as an accrued liability when we report our May's financial statements. You're typically going to report it as utilities payable. In your homework examples, the more common type of accrued liability that you will see is going to be salaries payable. This would represent the amount of expenses that we owe to our employees who have worked for us, but we have not paid them till the following accounting reporting period. Finally, let's take a look at our equity accounts. There's nothing new that you haven't seen here before. So the equity accounts, typically you're going to see common stock and retained earnings. Remember, common stock is contributed capital. That's what the investors have contributed to the company. And retained earnings are amounts that have been earned and kept by the company since the beginning of time. Retained earnings have three components: revenues, which increase retained earnings; expenses that decrease retained earnings; and dividends that also decrease retained earnings. Going forward, we're going to have revenue and expense accounts separated as we learn our debits and credits.